Just wanted to give you an update on standard deviation of daily price changes for these US dollar pairs, the most popular US dollar pairs: Euro dollar, pound dollar, dollar yen, dollar Canadian dollar, Australian dollar, Swiss franc, and New Zealand dollar. And right here we've got 3 time horizons: 1 month, 3 month, and 6 month. And the typical from the research team here and more standard practice would be to center around that 3-month average. And what this tells you is in pips, how 68% of the time, give or take, how many pips a pair will move based on rolling daily closes. So not the absolute max min of the day, but the actual closing prices. And we're seeing some interesting trends. Of course, we're seeing from the 6-month to the 1 month a bit of a contraction as global FX volatility has come in a good deal with a ton of volatility elsewhere, especially in those metals markets. That's a common trend across all these pairs. You're seeing it get hit everywhere. But what is a reassuring sign is if you compare the 3-month and the 1 month of the euro dollar, we're starting to get a little bit back, a little bit of juice back into this euro dollar, coming from 25 pips to 28, but still not at the 32 that we see over the longer term. Other than that, I mean, an Australian dollar below 20 pips is pretty compressed. You can relay these on top of, the chart, the recent tape action, and perhaps validate if it's more of a global volatility compression or if it's in a pair specifically, perhaps some compression, a coil, if you will, that might steer you to the next potential breakout. Other than that, across the board, we're seeing the US dollar, Japanese yen being under 50 pips. We talked about it, right? The volatility coming in there. Mm-hmm. That's, I think, the first time I've seen it in 3 years under 50 pips when I've run these, which is pretty surprising. But yeah, big picture, the only other variable I'll throw in there is, even though we can compare these directly in pips, right? What that means from a product perspective is it actually sets up, there are a few more components involved in how this could correlate to your P&L. For instance, we see the biggest movements in this dollar yen, and you think, okay, this might be a place with the most volatility where I can get the most potential opportunity. But given the margin requirements, that pair at 5% or a leverage of 20 to 1 can actually act very differently than a euro dollar at 50 to 1 leverage or 2% margin, even if it is a little more than half the daily range in pips. Similarly, you have something like the Australian dollar, New Zealand dollar, which around 20 pips of daily change. Those are margined at 3%, a leverage of 33 to 1. And you have the backdrop of what the current exchange rate means in US dollar terms. And it can be very cheap to enter those positions and get perhaps a larger P&L out of the same number of pip movements. So it's worth poking around there and seeing what the actual implications are of these ranges. But for active traders, on the next slide, we can look at what this means, how you could potentially use it. And it just gives you a kind of normal move baseline, at least for right now. When you open the platform and you see the net change, it'll be quoted, with some zeros in it. But if you read it as I'm reading it right now, we've got 17 pips on the euro daily change, only 5 on the British pound, but we've got 24 on the Australian dollar, US dollar pair. And if we remember what it was, the 1 month move for daily price changes in that pair right now, around 17, you could potentially take action here and say, okay, maybe this move is a little overdone. I mean, especially if you would have caught it 3 hours ago, right? We got up maybe another 10, 15 pips. And so you can use these as a guide rail for perhaps contrarian traders that think, 68% of the time, we'll finish within this range. If I see a move outside of it, perhaps I'll think about fading it. But also just regardless of direction, considering your stop placements and potential take profits in a low volatility environment, like we saw with your long US dollar Swiss franc position. If you're not monitoring these things overnight, it might behoove you to factor in something like a take profit, just because we aren't seeing the swings that we normally do. And if you get dinged once and aren't there to monitor it, might be worth taking profits where you can get them. And just understanding the currency pairs, like I talked about, the actual product specifications and what moves in pips could mean for us traders, that it settles in US dollar, factoring in not only the margin requirement, but the actual exchange rate itself, which could lend itself to more potential opportunities.